Hello, everybody. Welcome to the Crypto Hipster Podcast. This is your host, Jamil Hassan, the Crypto Hipster, where I bring you founders, entrepreneurs, executives, thought leaders, artists, and musicians all around the world in crypto and blockchain. And today we are in for a treat. I have an amazing guest, an absolutely amazing guest. He is the founder of Arca. His name is Jeff Dorman. Jeff, welcome.
Thanks for having me.
Very welcome. Very welcome. So let me ask you the first question is what is your background, and is it a logical background for what you're doing now?
It's logical to me. I don't know if it was accepted when I first got into digital assets, but yeah, I started in my career in traditional finance. I was an investment banker at Lehman Brothers. I was a bond trader at Merrill Lynch. Then I went to the buy side and learned how to manage portfolios of mostly debt and equity securities down to high yield and distressed. About 13 or 14 years into my career, I left Wall Street to go work at a FinTech company, which was really the first time that I kind of left the myopic, world of Wall Street and surrounded myself with a different caliber and group of people, especially the 10 full stack developers that we were working with at the time. And it was there working in FinTech for a few years where I sort of saw a lot more about what finance had to offer other than just, managing debt and equities, and everything from, seeing more of the venture capital world to, the people who were kind of coming up in blockchain and mining for Bitcoin and Litecoin and Ethereum and kind of building this new financial world sort of opened my eyes, and having both the technology background as well as sort of a macro investing background. Bitcoin immediately made sense to me, but I never thought of it as more than just a hobby. I thought of it as just an interesting thing to hold in your portfolio and see what it would be 20 years later. But it was when I got introduced to Ethereum and other smart contract protocols and started to understand what could be built on blockchain and all the different facets of it. That's when it really started to get interesting to me as a career, and when I started to think about why my background made sense, right? Because basically, in a nutshell, all tokens are hybrid securities, right? They're part financial instrument that you can model no different than a bond or a stock with regard to cash flows and discounted cash flows and present value. And then it's part, utility or network effect or loyalty, rewards, which is much more on the technology side. So it really does sort of bridge all of the different aspects of my career and my background into one area.
Awesome. Not too many people I've talked to talk about this kind of cash flows, so it's good. So let me ask you, then Arca, what is Arca all about? Including you got what you guys are unique at.
Yeah, I mean, a lot of what we're all about is sort of an extension of what I just said, and really what you just said. Right? You said a lot of people don't talk about this cash flows, and it's because most of the people who have entered blockchain came to this world from one of three areas, right? Either they were quantitative traders and just saw a new market that was liquid that they could use their old models. There's not a whole lot of valuing the individual instruments in that case. You're kind of just looking at correlations and patterns. Two is there was the venture community, right? The early venture capital community really just liked the idea of what blockchain could be from a network effect standpoint. And again, not really looking at the financial aspect, more just looking at the growth aspect. And then, of course, you had the technology people, right, who were building and looking into how to make blockchain applications. And again, probably not the most financially minded. And what we did at Arca, myself and my co-founders, Rain Steinberg, who came from a financial background as well. He was one of the co-founders of Wisdom Tree, and also Phil Liu, who came from a legal finance background, having been a product structurer and lawyer, a variety of different managed futures and other fund platforms. Where we kind of saw this industry going was that eventually you're going to have adults in the room and people who understand regulated finance, who understand what it takes to build an asset management or a while adhering to existing rules and regulations. And that was really what Arca wanted to build. Was we wanted to build a full service asset management firm that took the best practices from Wall Street, regulated, compliant, legal structures, and applied them to digital assets. And really nobody had done that prior to us and a few others. So we started with a couple of hedge fund products that were applying, again, the same investing skill set that we had in the debt and equity world to digital assets. And then from there, we expanded into other product lines. So we have multiple fund strategies at Arca now. We also have some regulated product offerings that are using blockchain as the rails, and also have an innovations and lab division where we're trying to create and structure new products for ourselves and others. So ultimately, that's what Arca is trying to do, is really be that bridge, or be that liaison from this traditional Wall Street regulated world to this new and in my opinion, most exciting asset class we've ever seen.
Awesome. And I think you were deeply committed to some of the founders and products that you invested in. A lot of people will know at first sign of trouble will dump a token, but have been really committed to some of the founders. How's that experience been for you?
Yeah, and it's not necessarily just the founder. Obviously, founders are a big part of it, but also, a lot of the people at Arca, myself included, came from a distressed debt background, right? And when you're trained in distressed, you're looking to run towards the train wrecks, not leave them. It's a little different in the venture community, right? Venture community is scattering your bets around 100 long shots and hoping that one or two of them hits, and really leaving the rest for dead. Um, so our mindset has always been, when there's trouble, you want to dive head first into it, because that's usually where the opportunity and where the alpha lies. There's a lot been written and talked about correlations and how, in this asset class, and how all tokens are the same. And the reality is, it's not really true, right? Over maybe longer time period, the asset class itself might be more important than some of the individual assets. But when you look at shorter time horizons, or you look at a handful of specific tokens, they're very different. They're very different in the way they're structured, right? They have different issuer types, from DAOs and decentralized entities, to corporations, to effectively currencies. You have different token types, from those that are meant to just be transfer of value, to those that are asset backed, to those that are these hybrid securities that have both financial value as well as utility value. You have all kinds of different sectors, right? What used to be just Bitcoin and currencies now includes DeFi and centralized finance and gaming and NFTs and stable coins and Web3, and you name it. And as a result, getting your hands dirty and diving into the ones that have problems is generally where you can create a lot of the alpha, right? Because you can restructure tokens, you can change the dynamic, you can make adjustments to a good project with a bad token. And we found some success doing that. Essentially it's just an extension of value investing, but doing it with a more active approach.
Interesting. Very cool. So I've been receiving this newsletter from you guys for a year or more than a year. And it's in there I remember the tagline says, "That's our two Satoshis," right? So I just wanted to find out what your view of the two Satoshis is.
Yeah, I mean, for those who don't know, a Satoshi or a Sat is the smallest denomination of Bitcoin, right? So the old expression, "That's my 2 cents," we just turned it into "That's my two Satoshis." I don't remember. I think it was a shout out to Sasha Fleischman, one of my guys here at Arca, who I think came up with that title. But we've been writing this for 5 years, and the reason for it is, we think education is the biggest barrier to entry to this space. There's a lot of people who know how to value stocks, and how to value bonds, and how to value real estate, and how to value commodities. And that wasn't always the case, right? It's because there's been hundreds of hours of research and dedication and books written about this. I mean, you can look back to, Warren Buffett's Principle of Investing really came from the book that was written in the 1920s, from Graham and Dodd. If you look at the success of great bond investors from Howard Marks to Michael Milken, right? That came from a book written in the 1960s called the Fixed Income Securities Handbook, which talks about how to value different fixed income instruments. Well, none of that exists in crypto, and as a result, there's just a lot of bad information out there. People still tend to think Bitcoin and other tokens are the same when they're completely different. People tend to think that you can't value these instruments and they're all just trading instruments, which in our opinion is completely wrong. So when we started Arca in 2018, first thing we did before we even formed any of our funds or had any of our business lines was we started writing. We just started writing about the market, what is happening from both a market impact standpoint to defining some of these instruments to kind of the evolution of the industry from just Bitcoin to now all these different sectors and token types. And it's really, been a helpful in a few different ways, right? One, it's given serious investors a chance to understand and learn about this space outside of just the media who tends to focus on the frauds and the problem areas and not necessarily the growth areas. But two, it's been helpful for our own investment process. I've been a big believer really since I started my career 23 years ago that if you can't articulate your views through writing, then you probably haven't really fully vetted and developed them yet. So I encourage not just myself, I do the majority of the writing of that particular newsletter, but everybody on the Arca team, we encourage writing, public research and public facing educational materials, because if you can explain it to the lowest common denominator or to the people who don't really know about it and don't understand it, chances are you understand it pretty well yourself. So that newsletter you're referring to comes out every week on Monday on our website at ar.ca, but also we have a whole resources section on our website as well, which goes into everything from token taxonomies to understanding different instruments like blockchain transferred funds to defining decentralized governance and ESG and all the other things that we find really interesting about blockchain.
Very cool. I was thinking about Satoshi Nakamoto's the two different points of view, and I was like, make for like the 2 cents, that makes all the sense in the world to me. So, let's talk about your 2023 predictions, because a lot of people made predictions in 2022, and no one predicted the CFI implosion. So you have some predictions for 2023, and the first question I have is about your predictions is, how will digital assets as an asset class decouple from traditional markets and remain uncorrelated going forward?
Yeah, and we've been running these outlook pieces for a few years, and sometimes we're right, sometimes we're wrong, as you mentioned. I don't think very many people called the implosions of so many of the once stalwart companies of digital assets last year. But some of the writing was on the wall with regard to how much just leverage there was across the system, and certainly some companies that in our opinion weren't necessarily the most kosher. But yeah, 2022 was definitely certainly outside the norm that we were expecting. In terms of 2023, though, I think it'll be quite different, right? For obvious reasons. One is that a lot of the bad actors in the space have either organically been cleaned up through bankruptcy or now through regulatory actions. But one of the things I think is probably most interesting is that a lot of people weren't paying attention to blockchain until really the last 18 months. And they didn't see that for most of blockchain and digital assets existence, that this was a pretty uncorrelated asset class. That what happened in the traditional world of debt and equities and real estate really had no bearing on what ultimately happened to the prices of these different digital assets. What happened in the last 12 months, or really last 14 months, right, starting in November 2021, was that correlation became really high, because ultimately the path that central banks around the world took on that inflation created a pretty strong negative wealth effect that affected everything, right? Last year was was the first year ever that both fixed income and equities were down more than 10% in the same year. And obviously, real estate is starting to get hit, and then the digital asset market down 60% plus, depending on where you look. So the common narrative now is that this is just another asset class that is going to be highly correlated to the rest of the market, and therefore it's really just a higher beta exposure to the same things. And that's what I would really challenge, because I think digital assets have historically been uncorrelated for a reason and will continue to be uncorrelated going forward here, because you really have totally different drivers of value. And what I mean by that is, you look at a traditional bond, like a corporate bond, or you look at the stock of a company, and it is incredibly impacted by rates and by cash flows. Meaning, the higher interest rates obviously will negatively impact a discounted cash flow model in terms of the terminal value of those cash flows. And also, if you have lower demand for goods and services, and ultimately you have lower cash flows, which reduces the value of a stock, and also obviously limits the ability to service your debt. But what's more interesting about digital assets is, again, most of them outside of Bitcoin, I put Bitcoin in a totally different class because Bitcoin really is more of a belief or a religion than it is a financial instrument. But the other tokens, for the most part, again, are these hybrid instruments. And the best way to think about what I mean by a hybrid instrument is, take Amazon, for example. You have Amazon shares, which represent the revenues and the cash flows of Amazon as a business, right? The better Amazon does as a business, the more those revenues and cash flows increase, the more money you make as a shareholder. But now you have now you have Amazon Prime, and Amazon Prime is really more of the loyalty or the utility value of Amazon the business, right? It gives you shipping, free shipping. It gives you movies. It gives you music. It gives you Whole Foods discounts, right? You get all these different value drivers from that. You can very easily be an Amazon shareholder without being an Amazon Prime member, and vice versa. You can be a Prime member without being a shareholder. So as a result, the two different values, which are not the same, accrue differently to different people in the Amazon ecosystem, right? Customers, if there's a huge recession and Amazon shares go down 50% because Amazon's revenues and cash flows go down, that doesn't necessarily mean that you're going to derive less value from downloading music or watching movies or getting Whole Foods discounts and all the other perks that come with Amazon. What tokens do is they really combine those two. So instead of having these different stakeholders getting different value drivers, a token gives you both. Most tokens are designed to be both your Prime membership and your equity in one instrument. So take, for example, Ethereum. Right? Ethereum has real revenues and cash flows. If you think of Ethereum just as like an app, as an app store, the more apps that are built on Ethereum and the more transactions that happen, the more revenues and cash flows through fees are generated for Ethereum. And those revenues and fees go directly back to token holders. And as a result, part of Ethereum's value can be valued in the form of an equity, right? In the term of discounted cash flow on revenues and the profits of Ethereum. But also, Ethereum has this utility or benefit value, right? You can use ETH across DeFi as collateral to use different DeFi products. You can use Ethereum as the gas or the currency of any of the apps and the ecosystems within Ethereum. As a result, there is a utility value to Ethereum as well, right? More of this kind of rewards, loyalty, a value that's different. So ultimately, when you go back to like, why will you see a divergence of digital assets from debt and equity this year? It's because we probably are heading into a recession. We are going to see lower cash flows, lower revenues, which is going to negatively impact both equities and debt. But those same drivers are only going to partially impact digital assets, but the utility value, this usage value, will only continue as you see more and more companies and projects getting involved in this space. So I do think digital assets will likely prove to be more recession-proof than equities if we have a downturn. And I also think they will prove to be a higher growth asset to the upside if you see, a return to growth. And either way, I think digital assets are going to perform better than debt and equities in 2023, and also, like I said, ultimately decouple and have very little impact on what's happening with the Fed or central banks or everything that really drove returns in 2022.
That makes sense to me. I'm looking at the value of the cryptocurrencies I have as hopefully outpacing the price of groceries. So
That's what people forget about inflation is, while everyone blames inflation for the returns of 2022, the reality is it wasn't inflation that drove negative returns in 2022. It was the speed of the response of central banks to inflation that ultimately, hampered demand and lowered expectations of cash flows. But inflation itself can only be beat by owning assets, right? You do have to own assets to beat inflation. So even as inflation subsides, it still exists. And as a result, you need to own real estate. You need to own equities. You need to own digital assets. You need to own things that will outpace inflation. And I think, broadly speaking, digital assets will be, one of the better ways from an inflation adjusted perspective to earn positive returns.
I agree. So you guys, well, I think everybody's looking at this, but trying to onboard traditional finance corporates, right? How do you onboard them, and what are the necessary rails to make them integrate blockchain into their existing operations processes, especially for like big corporates?
Yeah, I mean, to start with, I think you got to think broader, right? So first is will blockchain actually be adopted by all these different entities? And in my opinion, it's obvious that they will, right? The analogy would be, in the early internet days, I call the late '90s, early 2000s. Most of the internet companies were organic native internet companies, right? Companies that would not have existed if not for the internet. Your Amazon.com, Pets.com, Priceline.com, right? These are things that could not have worked before the internet. But 10 years later, every single company and entity in the world was using the internet, right? The biggest internet companies became Domino's Pizza and Walmart and JP Morgan and you name it, right? I mean, everybody just started to utilize the internet. And as a result, it increased growth and customer participation across a variety of industries that existed, 50 to 100 years before the internet itself existed. I think that's where we're headed here in blockchain, is that the first wave of blockchain companies were dot cryptos, right? Or blockchain native companies that would not have existed without blockchain. And now you're starting to see that shift. You're starting to see Starbucks and Apollo and KKR and JP Morgan and Nike and all these other companies start to get involved in blockchain. And ultimately, I think it extends further. Right? I think universities and municipalities will start to figure out how to issue a token so that you can engage your customer base and have better stakeholder alignment than what currently exists. So to your question of how does that happen? Well, first you have to have the pioneers, right? You have to have the companies and projects who do it first, who spend the necessary R&D to learn about this, and try some things, right? I mean, Starbucks is a great example. Starbucks has one of the most widely used loyalty reward programs in their Starbucks points, and they're starting to roll out NFTs and other digital collectibles to these community members to try to see if they can increase customer adoption. Nike's doing the same thing, right? Nike has a whole NFT line tied to their shoes and other merchandise. And as these companies show success and revenue and customer growth, others are going to follow suit, right? We're seeing the same thing in finance. JP Morgan and BNP, for example, and SocGen have been utilizing various aspects of decentralized finance applications. KKR just tokenized one of their funds. Apollo has been working on tokenizing their securitizations. So once a couple of other finance companies do it, then everyone follows suit, right? Nobody wants to be first, nobody wants to be last. And what happens here is a couple of different things, right? One is these companies and businesses start to hire their own blockchain groups, and they start to try to build organically and figure out how they can utilize it. And they'll also start, tapping into existing protocols that have already been built, and trying to grow that way as well. And ultimately, what happens is almost all of the users that you're seeing today. I mean, I think we estimate there's about 200 to 300 million crypto users today. I mean, that gets dwarfed by the amount of customers that are already at these existing companies. I mean, Visa alone has 300 million customers. iTunes has 225 million customers. Delta Airlines has 100 million customers. Starbucks, I just mentioned, 60 million customers. So when you start tapping into these existing user bases and audiences, and they start adopting blockchain, all of a sudden you start to see the growth of these different protocols and these different blockchain rails start to work. So how do you make it happen? it's just the way technology works, right? Usually you have the organic native companies start first, and then you have the existing companies and projects start to spend real money on R&D and staff to figure out how to integrate with these new technologies.
Yeah, that makes sense. And then you said TradFi will start to lose market share to DeFi. I just want to see how that's going to. Well, I guess that goes the same answer, right? How that's going to happen, and what needs to be present but is missing right now in crypto in order to make that the companies go to DeFi instead of sticking with TradFi antiquated.
Yeah, yeah. I mean, there's a couple different ways that happens, right? So first and foremost, right now, the way people will express their view of what 2022 was is people will say it was the year that crypto failed or blockchain failed, right? Because there was all these high profile failures from Celsius to Voyager to BlockFi to FTX and everything in between. Ultimately, though, what the book on 2022 will likely be, years from now when the emotions wear off, is that decentralized finance applications absolutely performed, admirably in the face of all of the centralized competitors going into the top. For every single centralized entity that went down, because some human or some board of directors made bad decisions, there was a perfect substitute in the DeFi world who had the exact same customers and did the exact same thing that still exists and still operating fine because code makes better decision than humans, right? When you program code to do certain actions, it's not going to be emotional or make, relationship driven decisions. It's going to execute the code. So you look at FTX, right? FTX failed with their risk management and obviously some corporate fraud as well. But FTX failed, even though what FTX did is the exact same thing that Uniswap and DYDX and GMX do. And those decentralized protocols are still operating fine. BlockFi and Celsius failed, but their counterparts, MakerDAO and Aave and Compound, decentralized lenders, had the same customers and they thrived and they did fine. And I think the world is starting to take notice of that, that independent of your view on Bitcoin or independent of your view on these, specific companies and the people behind these companies that failed, the protocols themselves, the code itself just works better. And once that happens, once you start to see that proof of concept, it makes sense that companies are going to want to figure out how to build on that, right? And it doesn't have to be one or the other. It's not like it has to be a black or white. It's not like JP Morgan goes away because DeFi protocols succeed. It's more likely to be JP Morgan taps into DeFi protocols to enhance their business. No different than how, when the robo advisors first came out, Betterment and Wealthfront, there was a school of thought that, financial advisory was going to go away because Wealthfront and Betterment had better technology. And that's not exactly what happened. What happened was Wealthfront and Betterment proved that the technology works in terms of automated advisory. And then the large investment advisory firms, your Morgan Stanleys, your Merrill Lynch's, et cetera, just started to either buy or build their own robo-advising businesses and integrated it with their existing business. And the same thing will happen, is that as these DeFi protocols prove that they work, as they prove that they're faster and cheaper and have better risk engines, ultimately the larger financial institutions will start to utilize these for a piece of their business at first, and then eventually, in my opinion, eventually all of their business.
Yeah, I saw that when I was looking at the Celsius transactions over the summer. Once they froze everybody's accounts, they were still sending money like clockwork through Aave, to pay off their debt. It worked,
Yeah, exactly. I mean, you can have a relationship with a banker and try to, buy time and do all the things that people would respond to, but you can't do that with computer code. It's, if you're going to get liquidated, you're going to get liquidated. So you have to top up your collateral. And you saw that, like you said, as Celsius was going down, they were still paying off their loans through DeFi because they had no choice, right? It was there was no way to get around that.
So thank you. Yeah, I'm looking forward to seeing your predictions at the end of the year. Maybe we can have a follow up in the early part of next year. I want to move on to one question because I got a updated newsletter this week. It says moving to Ethereum, right? That Ethereum and some of the promises of technological change. How has Ethereum pivoted over the course of its life cycle to meet those promises and where do you think that Ethereum is going to be headed over the next few years?
Sure, yeah, and a shout out to one of our research analysts here at Arca, Nick Holtz, who wrote this piece. But Ethereum has been really interesting, right? Because at times it has been just thought of as a competitor to Bitcoin or as a in Bitcoin's shadow, right? But really, they're completely different things, right? Bitcoin, like I said, for all intents and purposes, is just a currency or just a store of value. It's a belief system. It's something that people believe has value, and therefore it does. There's not a whole lot built on top of Bitcoin, right? There's not businesses who are building apps or doing things on the Bitcoin protocol. The Ethereum protocol, when it was first introduced by Vitalik, was thought of being like a world computer or like an app store, right? Where it was ultimately going to be a protocol for building decentralized applications. And while that vision has largely been realized, there's actually been quite a lot more, built on top of that now, beyond just this idea of kind of being a world computer. And ultimately, where the roadmap is, if you look at, it's a little complex for people who don't write code themselves. But if you look at, sort of the roadmap of where Ethereum is headed, what it really, the crux of the shift, I guess, is it can still do all the things that Ethereum set out to do, but really it's going to be less about being for applications themselves to be used by retail or everyday customers, and be more of a settlement layer for other blockchains. Basically, if you think about what a protocol is trying to solve for, there's three things. It's trying to be decentralized, it's trying to be fast, and it's trying to be secure. And it's really impossible to do all three of those things at once. The more decentralized you are, and the more secure you are, you're going to give up on speed, and vice versa. And what Ethereum's real value is that security layer, and is that decentralization, and they're giving up speed as a result. So what happens is you're going to see this multi chain world where you have other protocols and or other layer 2 side chains that build into the Ethereum protocol that ultimately handle the speed and the user costs, and then they flow through eventually to Ethereum as that security and decentralized layer. So what that means is you ultimately have fewer transactions actually happening on Ethereum, but much bigger transactions happening on Ethereum. So basically, a layer 2 or another blockchain absorbs the fast and small and everyday usages, and then ultimately a big block transaction will happen on Ethereum. So sort of think about it as, if you're doing millions of transactions at a Starbucks every day, that wouldn't happen on Ethereum. But ultimately, when Starbucks takes that money and decides to put it into a bank, that one big lump sum transaction would be what happens on Ethereum. And I think as that happens, it really opens the door for where we're hoping that blockchain goes to, which is being an everyday use case for settlement and for value transfer. I think what we learned in the 2021 bull market was that none of the protocols that existed really were able to scale fast enough for the amount of demand that we saw in 2021 during the bull market. And that's why you started to see Ethereum's market share get eaten into by Solana and Avalanche and Binance Smart Chain and all these other layer 1 protocols that existed. I think where we're headed in 2023 and beyond now is that, okay, we get it. We know that it didn't work correctly in 2021 in terms of scalability, but now we're seeing the Starbucks and the Nikes and the JP Morgans and all these other big businesses start to build on these protocols. In order to handle that scale, we have to utilize these layer 2 sidechains and these other blockchains for the everyday faster transactions that will eventually, like I said, get settled in bigger chunks on the Ethereum network. So it doesn't change much in terms of the belief or the vision of Ethereum, but ultimately it allows for much bigger, broader applications and things that require fast transactions like retail spending and gaming and things that have much higher throughput. Will still be able to utilize Ethereum for what it's good for, which is settlement and decentralization and security.
Makes a lot of sense. And from what you just said, we need more than one, just one side chain. So
yeah, I mean, I think it's pretty set in stone at this point that we are going to be into a multi-chain world, right? It's not going to be winner take all. You're going to have a lot of different chains that do a variety of different things, and ultimately many of them will probably have niche use cases.
I agree. Awesome. Well, I want to thank you very much for your time today. This has been an amazing conversation. I enjoyed speaking with you. And I have one last question, and this is an easy one. And it's how can people find out more information about you? How can they find out more information about Arca? How can they follow you guys? How can they get your newsletter? How can they do any of that?
Sure. Yeah, we best way to start would be going to our website. It's just ar.ca. There you can get to our blog, you can get to our resources and education center, and you can certainly reach out to the various departments at Arca across investing and product creation and advisory. And then elsewhere, people can follow me on Twitter at jdorman81. Or they can follow the Arca account itself at ARCA.
Awesome. Thank you very much for your time today.
Absolutely. Thanks for having me, and look forward to talking to you again soon.